Preparing for a consumer credit analysis at Santander interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a credit analyst at Santander? Santander appeals to me because it combines a large banking platform with meaningful consumer lending exposure. I want to use financial analysis, data interpretation, and sound judgment to help distinguish attractive borrowers from avoidable risk. The role also offers exposure to underwriting, portfolio monitoring, and credit policy rather than isolated spreadsheet work. I would bring attention to detail, a questioning mindset, and a strong commitment to responsible lending, while continuing to develop my understanding of Santander's products and risk appetite. While answering, connect Santander's banking platform, consumer finance exposure, risk culture, and analytical development opportunities with your own experience, motivation, and understanding of responsible lending and portfolio performance. Question 2. How would you assess an individual's creditworthiness? I would assess creditworthiness by establishing whether the applicant can repay comfortably and whether the information is reliable. I would review verified income, employment stability, existing obligations, debt-to-income or payment-to-income ratios, credit history, requested term, and loan purpose. For secured lending, I would also consider collateral value and loan-to-value. Finally, I would look for inconsistencies or fraud indicators and compare the case with policy and risk appetite. The conclusion should reflect affordability, not simply approval probability. Make sure to cover income stability, debt service capacity, employment, credit history, collateral where relevant, loan purpose, affordability, fraud indicators, and the importance of evaluating both quantitative and qualitative evidence. Question 3. What is the difference between probability of default, loss given default, and exposure at default? Probability of default, or PD, measures the likelihood that a borrower defaults over a defined horizon. Loss given default, LGD, estimates the percentage lost after recoveries, collateral, and workout costs. Exposure at default, EAD, is the balance exposed when default occurs, including likely future drawings where relevant. Together, they support expected loss, PD multiplied by LGD multiplied by EAD. For example, stronger collateral may reduce LGD, while revolving utilization behavior can increase EAD. In your answer, define PD, LGD, and EAD clearly, explain their different roles in expected loss estimation, and show how collateral, utilization, recovery costs, and borrower behavior affect each measure. Question 4. How would you analyze a consumer loan application? I would begin by validating identity, income, employment, and the requested borrowing purpose. Next, I would calculate affordability using verified income and existing commitments, then review bureau history, recent inquiries, arrears, utilization, and any public records. I would assess application and behavioral data for fraud or inconsistency, apply relevant policy rules, and consider the risk grade and pricing. If an exception exists, I would quantify it, document the rationale, and state clearly whether the risk is acceptable. Be sure to mention document validation, affordability calculations, bureau data, application characteristics, fraud checks, policy limits, risk grading, exceptions, and the need to explain a clear approval or decline recommendation. Question 5. Which financial ratios are most relevant when analyzing a consumer borrower? For consumer lending, I would prioritize payment to income or debt to income because repayment affordability is central. For secured loans, loan-to-value helps assess potential loss severity. I would also examine revolving utilization, cash flow surplus, delinquency history, and the stability of income. No ratio should be viewed in isolation. A high debt-to-income ratio may be manageable for a high-income borrower with stable employment, while apparently acceptable leverage may still be risky if income is volatile or documentation is weak. Focus on debt-to-income, payment-to-income, loan-to-value, utilization, delinquency history, disposable income, and cash flow coverage, explaining that ratio usefulness depends on product type, borrower profile, and data quality. Question 6. What warning signs might indicate that a borrower is becoming financially distressed? I would watch for missed, late, or partial payments, increasing utilization, repeated overdrafts, returned direct debits, declining income, and multiple recent credit applications. A borrower requesting hardship support or restructuring may also signal stress, even before formal default. At portfolio level, I would monitor roll rates, delinquency migration, average balances, and bureau deterioration. The key is to distinguish temporary payment friction from sustained affordability pressure, then escalate consistently under the bank's monitoring and collections framework. In your answer, discuss missed or partial payments, rising utilization, overdrafts, falling income, multiple credit applications, restructuring requests, bureau deterioration, and behavioral changes across the portfolio. Question 7. How do interest rates affect consumer credit risk? Higher interest rates generally increase monthly payments for variable rate or refinanced borrowing, reducing disposable income and raising default risk. They can also weaken demand, increase payment shock, and reduce recoveries if asset values decline. I would separate fixed rate from floating rate exposure and analyze repricing schedules, borrower buffers, and maturity concentrations. In a stress test, I would apply rate increases to payment calculations, estimate delinquency migration, and assess whether provisions and capital remain adequate. Make sure to explain repayment affordability, variable versus fixed rate exposure, refinancing pressure, disposable income, defaults, prepayments, and the importance of stress testing borrowers and portfolios under higher rate scenarios. Question 8. How would you explain expected credit loss under International Financial Reporting Standards 9? International Financial Reporting Standards 9 expected credit loss is a forward-looking, probability-weighted estimate of credit losses. Stage 1 recognizes 12-month expected loss for performing exposures. Stage 2 recognizes lifetime loss after a significant increase in credit risk. Stage 3 applies lifetime loss to credit-impaired exposures, with interest treatment changing. I would consider historical experience, current conditions, macroeconomic forecasts, and scenario probabilities. I would also challenge assumptions, data quality, and any management overlay used where model output misses emerging risk. Cover the forward-looking, probability-weighted nature of ECL, stages 1 through 3, 12-month versus lifetime loss, reasonable forecasts, scenario weighting, and management overlays or judgment. Question 9. What would you look for when reviewing a credit risk model? I would assess whether the model is conceptually appropriate, uses reliable and representative data, and discriminates effectively between good and bad outcomes. I would review Gini or AUC, calibration, stability, backtesting, missing values, overrides, and performance across key borrower segments. I would also challenge variable definitions, explainability, potential bias, and documentation. A model can perform well historically yet fail after economic change, so ongoing monitoring, validation, and clear escalation thresholds are essential. Discuss discriminatory power, calibration, stability, data quality, variable logic, interpretability, validation results, backtesting, overrides, bias, documentation, and whether the model remains appropriate for the portfolio and purpose. Question 10. How would you use a credit score without relying on it blindly? A credit score is a useful risk ranking tool, not a complete credit decision. I would understand what drives the score, its development population, recent performance, and applicable cutoff. I would then validate affordability, income, employment, fraud indicators, and policy compliance independently. A strong score should not override unaffordable borrowing or inconsistent information, while a weaker score may warrant investigation rather than automatic rejection. Any manual override should be evidence-based, documented, and monitored for performance. Be sure to mention score interpretation, underlying drivers, policy cutoffs, bureau limitations, affordability, fraud, exceptions, overrides, and the need to combine automated decisioning with professional judgment. Question 11. What is vintage analysis, and how would it help Santander monitor a loan portfolio? Vintage analysis groups accounts by origination month or quarter and tracks delinquency, default, or loss as each group seasons. It helps identify whether newer production is deteriorating faster than earlier cohorts and whether a policy, channel, product, or pricing change affected performance. I would compare vintages on a consistent basis, control for seasoning and economic conditions, and investigate outliers. The results can inform underwriting changes, collection strategies, impairment assumptions, and management reporting. In your answer, explain grouping loans by origination period, comparing delinquency or loss curves, identifying underwriting changes, separating seasoning from macro effects, and using findings to refine policy and forecasting. Question 12. How would you investigate a sudden increase in delinquency rates? I would first confirm the increase is genuine by checking definitions, data feeds, payment processing, and reporting cutoffs. Then I would segment the movement by product, vintage, geography, origination channel, risk band, and delinquency bucket. I would compare trends with unemployment, rates, inflation, and peer or historical behavior. I would also test whether policy or collections changes contributed. Finally, I would quantify likely losses, identify root causes, and recommend targeted actions rather than imposing a broad response prematurely. Focus on validating the data, segmenting by product, vintage, geography, channel, score, and delinquency bucket, checking operational causes, comparing macro drivers, and recommending proportionate corrective action. Question 13. What is loan-to-value, and why does it matter in consumer finance? Loan-to-value equals the outstanding loan balance divided by the collateral's estimated value. A lower LTV generally provides more borrower equity and a stronger recovery cushion if default occurs, reducing potential LGD. However, the analysis depends on valuation quality, depreciation, market liquidity, repossession costs, and timing. For vehicle finance, for example, rapid asset depreciation can weaken protection even when the initial LTV appears acceptable. I would therefore combine LTV with affordability, credit behavior, and collateral trends. Explain the LTV calculation, relationship to collateral protection and LGD, valuation risk, depreciation, borrower equity, recovery costs, and why LTV should be combined with affordability and behavioral analysis. Question 14. How would you assess an auto finance portfolio during an economic downturn? I would assess both borrower repayment capacity and collateral recovery risk. Rising unemployment and inflation could increase missed payments, while falling used vehicle prices could reduce recoveries and raise LGD. I would review delinquency roll rates, vintage curves, score bands, income sectors, loan terms, LTV, and geographic or dealer concentrations. I would then stress unemployment, rates, and vehicle values, estimate PD and LGD impacts, and evaluate whether provisioning, collections capacity, and risk appetite remain appropriate. Cover unemployment, payment affordability, used vehicle prices, repossession and recovery timing, vintage performance, borrower segments, delinquency roll rates, provisions, stress scenarios, and portfolio concentration. Question 15. How do you balance growth targets with prudent credit risk? Growth is valuable only when it generates risk-adjusted returns and remains within appetite. I would evaluate contribution after expected loss, funding costs, operating expenses, and capital, rather than focusing solely on origination volume. Growth should be targeted toward segments with sustainable affordability, appropriate pricing, and manageable concentration. If early warning indicators deteriorate, I would recommend tightening criteria, adjusting terms, or slowing a channel. Responsible lending and long-term portfolio quality should take priority over short-term production. In your answer, discuss risk-adjusted returns, affordability, pricing for risk, portfolio limits, concentration controls, early warning indicators, responsible lending, and the importance of challenging volume targets when evidence deteriorates. Question 16. Tell me about a time you found an error in financial or credit data. In a previous analysis, I noticed that a delinquency ratio moved sharply despite stable account counts. I reconciled the report to the source file, checked the date filter, and found that recently closed accounts had been included in the denominator but not the numerator. I quantified the impact, informed my supervisor, corrected the report, and added a validation check comparing account populations across periods. The experience reinforced that unusual movements should be investigated before being presented as genuine risk trends. Be sure to describe the context, validation steps, root cause, quantified impact, communication, correction, control improvement, and how you maintained accuracy without unnecessarily delaying the decision. Question 17. How would you present a credit recommendation to a senior manager? I would lead with the recommendation and the reason behind it, then present the few facts that materially support the decision. For an individual case, that would include income, obligations, repayment capacity, credit history, collateral, and policy exceptions. For a portfolio, I would add trends, expected loss, concentrations, and stress results. I would distinguish facts from assumptions, explain mitigants, and state conditions or monitoring requirements. A senior decision-maker should understand both the base case and the downside quickly. Focus on a concise executive summary, borrower or portfolio facts, key risks, mitigants, quantitative analysis, recommendation, conditions, downside scenario, and transparent disclosure of assumptions and uncertainty. Question 18. What would you do if a business stakeholder pressured you to approve a weak credit case? I would remain professional but anchor the discussion in evidence, affordability, policy, and risk appetite. I would explain the specific weakness, quantify the downside where possible, and ask whether verified information or an acceptable mitigant changes the assessment. If the case remained outside policy, I would document the rationale and escalate through the appropriate approval process rather than approving it informally. Consistency matters. Commercial urgency should not create unequal treatment or expose customers and the bank to avoidable harm. Mention objective evidence, policy and risk appetite, respectful challenge, documentation, escalation, consistent treatment, customer outcomes, and willingness to reconsider only when new verified information changes the analysis. Question 19. How would you prioritize tasks when several credit reviews are due at the same time? I would first rank tasks by risk materiality, regulatory or committee deadline, customer impact, and dependencies. Time-sensitive decisions with significant exposure would take priority over routine monitoring, while I would protect enough time for quality checks. I would create a visible task list, confirm expectations with stakeholders, and communicate early if deadlines conflict. Where appropriate, I would complete high-confidence analyses first and escalate capacity constraints rather than rushing a judgment. Good prioritization preserves both responsiveness and control. In your answer, discuss materiality, deadlines, customer and regulatory impact, risk severity, dependencies, data availability, clear communication, structured tracking, and escalation when capacity threatens quality. Question 20. What questions would you ask when reviewing a new consumer lending product? I would ask who the target customers are, what need the product serves, and how affordability will be verified. I would examine underwriting rules, pricing, terms, collateral, fraud controls, data availability, and expected PD, LGD, and EAD. I would also assess collections strategy, customer communications, regulatory requirements, operational capacity, and stress performance under unemployment or rate shocks. Finally, I would define early warning metrics, approval limits, portfolio caps, and review triggers before supporting launch. Cover target customers, purpose, underwriting criteria, pricing, affordability, fraud, data, collateral, collections, expected loss, stress testing, compliance, operational controls, and exit or review triggers. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.